It's Wednesday. It's a weekly webinar, 24th of April, 2024 Q2. Let's start. Frenkel Topping, anyone? What a name. Where did you get it from? Frenkel Topping. Pretty odd, isn't it? It's like a kind of a technique in bowling. Put a bit of Frenkel Topping on it, you know? That's it, bring it around. But they are an independent financial advisor specializing in providing advice and expert services to those seeking damages for personal injury and medical negligence. Upside, 48%. That's what the broker's got. Market cap 68, enterprise value 66. Again, nice. Not a lot of debt. The volume there is not huge. 35 grand a day. So, if you're anywhere near sort of tenth of that sometimes, even, or a fifth of it, and you want to buy or sell, you may be moving the price a bit. But nevertheless, 5 million operating profit. No debt. Cash there. Nice free cash flow. No. Sort of that. Green on the screen. So green, all good, apart from net profit growth. That's all good. Half year, full year, 32% growth. Operating profit, 75%. How does that translate into value? 2.1 sales, that's fine. That's fine. PE 34, a little bit toppy. In fact, it was less down here in the interims. But the EBITDA is fine, 11. Good health. Efficiency, good. 42, 15, 11, all good. I quite like that. There's a lot of green on that screen. The only thing it's not is it hasn't done this look. So that's the final sort of confirmation of an uptrend, pretty much, is that crossing, And so, Fen, let's have a look. It's come down from a long way. Like I say, it's trying to break that 200 before and just resume downtrend. Now, this may be starting. Look at that. It's literally, it's almost like a physical barrier, isn't it? That 200 moving out. Look at it. Bang in his head in it. Let us through. Come on, we're going into an uptrend now. No. You've been in a downtrend for way too long. You cannot come into the uptrend crowd. I think it'll do it, though. I think it's going to join the uptrend crowd sooner. Look at that. Nice turnaround of the 50-day moving average. Gapped up here in those results, which is a good sign. Whenever you gap up on final results, it's very good. Sanderson's, right? Okay. Sanderson's, right? Come out today. This is a good business, first and foremost. But at the moment, it's a tough time, of course, in the markets they're in, particularly in the UK. But I do like this business. And today, I literally, when it went down, I thought, good, it's getting cheaper. But I think there's potential here going forward. I think it's a quality business. And they do luxury interior furnishings company that designs, manufactures, and markets wallpapers, fabrics, and paints. In addition, the company derives. I remember when the cost of living crisis kicked in, this didn't really suffer too much. And I remember talking about, it was John on Vox. He said, maybe this, or maybe I said it. I said, maybe rich, posh people, because they do posh stuff, interiors and all that stuff. Having said that, they did recently do a contract with Blinds to Go. I don't Blinds to Go into that posh, are they? But they supply to, lots of big posh outlets. So maybe they're immune to the downturn. They're not immune, but it wasn't that much of a knock. And I quite like them. So I think going forward, they are one to watch. Like I said, companies like this have, a little bit of profit warnings, but not really profit warnings if it's flagged up. They're good businesses. Are, potential recoveries. And this is what I look out for. I think companies like this on the thing here. But look at the green here on the screen, okay? Upside, they've got 91%. That's the broker. That's because dropped today. Markup 70, enterprise value 54. It's all like this. There's plenty of cash. 16 million of cash, and they're making cash. All right, so that's not going to go down. And if you look at the net asset value per share, £1.21, they're now 99 pence. Now, if you look at a company, and just it's true value. Literally, what are net assets? Well, we know they are. You literally get to assets which you own, liabilities which you owe. So literally, you pay off all your liabilities, okay? And the net assets, everything left. Now the market values them less than that. I think it's a bit silly. So I genuinely think if you've got a profitable company, adding cash, your assets are going up. That's only going to appreciate. Let's have a real. I mean, they did say the outlook's still remaining challenging in the outlook, but I can't see them going to a loss. And in fact, they're not forecast to go to a loss. So keep an eye on companies like this. So the good companies are, literally below their net asset value per share, and they're generating cash because it's very rare that happens. in this market too. So it's in fact that happened last time with Good Energy, but this generates more cash than Good Energy. And I was buying it. And why is it going down? I understand this, but there's obviously a seller. It's very liquid, and then all of a sudden just shot up. So sooner or later, I think if they one whiff of some good news here, and I think there may be a turnaround, and I may start a rally. But see operating profit. This is a tough market. 9.7 million operating profit. Operating cash flow 9 million. Free cash flow 6 million. Okay, 3%. Big deal, you know. It's not a huge amount of downturn, so I quite like it. The value's all good. Look at that. Price of free cash flow, everything's good. The value's good. All it's missing is the growth. So that, if they go to a lower base, that'll come back, hopefully. And in fact, one of the brokers said that'll come back. Look at that, current ratio. They pay off their current liabilities 3.3 times, 60%. That's good for a sort of, design manufacturing business. 67% gross margins. Operating 8 is fine. Return on capital 10. I like this. It's just all about momentum. And if you can't be bothered to think about momentum, it's one of the things where you can chuck a little bit in and maybe wait, a tiny bit. But trouble is, when you start taking a tiny bit in, what happens is this. If the ship goes down again, I'm going to buy some more. And you end up leveraging down. Don't do that. So keep going, keep getting cheaper and cheaper and cheaper. And so you're better off waiting to see a bit of momentum happening because, you don't want to see it. So so they're saying growth is going back this year. 2020, I missed a 4 off there, haven't I? 2024, have I got it right? Yeah. Oh yeah, because it's January 2024 is the end date. So 2025 that should be. But 114, 170. So the growth isn't huge. It may not be a super stock. It may be a good recovery stock. They may grow more than that, it's all forecast. But what I'm saying is they're generating cash, and operating profits will go up to 11 million, 12 million. And so they're never going to be. So I've got 33% upside here. So, and that's on what? That is on literally the multiples. Yeah, look at that. 0.6 sales, 60 EBITDA multiple, and 12 pre-tax. So I'm saying, ladies and gentlemen, Sanderson, it's one for the watch list. Okay, put it on your watch list and add an alert. Like I said, like this. This is the ticker. This is the chart for Sanderson. Look at that way. So that's the kind of potential it can have in this upturn, And now we're bumping on the bottom here a little bit. Look at this. This pound level, which it almost broke down today. It's coming into play pretty much. So I think if you're looking for a good quality business, it's undervalued, I think, and just needs a little bit of growth, a little bit of recovery. This is maybe one. Generating cash, plenty of cash, very healthy, nice margins, all that's missing is not going to have breakneck growth. But you never know. When interest rates come down, people feel a bit more flush, start spending more. Property markets then will start getting buoyant. Of course, people start doing their homes and houses. That will stimulate their market. So it's all linked with that a little bit, isn't it? Of course it is. So interest rates come down, you may see a boost in this. But I do like Sanderson's. One for the watch list. Okay. So anyway, I say, so if you want to put alerts, 50-day, and of course, I do control on a Mac. Click on my keypad there, add alert. You got crossing, price, and you scroll down, hit that 50-day moving average there, and you got SDG. You don't type anything there, but I've already put in there, 50-day there. And I just, select that. And there's also 200-day or 20-day, whatever you want to do. Or you can just say, okay, I'm going to wait until it sort of breaks up here above these previous highs. But trouble with that is, with moving average, it's dynamic. It's moving with it, If you put it above these prices here, which is like a nice support level, then they could dip down even further. And so, that then, because this is sort of support level, it's almost breaking it here. They dip down below the support level, it needs to break back above that, but your price is up here somewhere. And so, so you're missing out. So it's best to put them on moving averages. And I tend to use 50 as a warning shot, saying, oh, and then, then keep an eye on it. If it breaks new highs above previous highs, after it crosses 50, it may be worth, investing a small little tranche, a tranche-arilla. FTC. These are like at the bottom almost. I took them off the list. So at the bottom of the MicroCap League, because the last year was disastrous. They've done a strategic agreement with SpaceX. They did a trading update. And they do say several significant contracts with new customers in the first half of 2024, including an important initial production for LEO's space market. These recent contracts win gives us better visibility of the medium term to the growing order book. As a result, we expect full year 2025 to be significantly ahead of current market expectations for both revenue and EBITDA. So, because they're 100, in fact, they shouldn't really be in this microcap list, but even the broker upside is 16% because the valuation was so high. I don't understand why the valuation was so high here. Because if you look at what they're doing, look, revenue 16 million, and they're something like 8 times. Is it going to be a 10-bagger? Not unless it gets that revenue up, because the price of sales multiple is quite high. Like I said, the average, of those 10-baggers was less than 3, pretty much, around at 3 or less. So I don't see it here. Operating profit 237 grand, and if you scroll forward, look at that. Look at that. 6.3 times, 6.5 times sales. No, thank you. But it does have some growth, but even that is not convincing. It's like 1624, 50% growth. They're still over 100 million market cap. And that's more like it. And I don't know what this is. I've just put 20% there for that because they don't have it going beyond this. But nevertheless, the margins, they're not too bad, actually. They proof is in the pudding. They've written the margins go from 2 to 12 or 13 net profit margin. That'd be an amazing transformation if it does. Because then you're saying, even now, if you get, 6 times or 3, was that 30 times? Yeah. What's that? 30 times PE. So, yeah, it's down here. 33 times, 6, even on today's share price. So, it doesn't get to a decent sort of, so 16 is not too bad if it gets to that. That's a real uplift in margins here and profit. So I don't really trust that it can do that. But who knows? But the share price really spiked up, and it was rallying anyway. And I thought, no, what? I know this sort of have climbs in the rocket space. I think this is it's just basically taking off like a rocket. Don't see it. Valuation is too rich. Not for me. I have put some alerts on it to see if it comes back into a decent valuation. You always do that just in case it drops off a cliff or something. But at this price, no thank you. Not for me. I'm out. Synectics went down today. There's lots of positives in there. There's one little negative. But remember, this is one of the highest in the MicroCap League based on growth, value, health, momentum, potential. And I think it's a great little company. I think this could get better as well. It's going to be like a bit like Journey, where it has the hardware and the software. And they announced today, look at this, AGM statement. I'm delighted to report that Synectics continues to build on the positive performance delivered last year and has seen a strong start to the current financial year in both systems and security. The company started the year well and have a strong order book in line with market expectations. It's in line with that, right? The board anticipated the results. We waited the second half. Okay, that was the only negative there. Okay, and I looked at their results. They are weighted the second half. I mean, if you look, so if you look here, they did, for the first half, they did 21 million. The second half, they did 49. So they are weighted 28 million in the second half. So they are weighted the second half. So people, that's a bit of an excuse. They haven't got any revenue. No. Calm down, everyone. It's fine. Look at that. Look at the scores here. The scores on the doors. All green. It's a cracking company. It's, it's got growth. It's got value. It's got momentum. It's got a good broker target. Margins are decent. And they'll get better because there's a bit of a recovery play. Health is good. That's why it scores on every metric. It's a top scorer on every metric. And literally no debt, cash of 4.6, and they're generating cash. It's got growth, value, health, efficiency. It's got everything. And it's going to get better. So I don't know why it came off a little bit today. It's just ridiculous. I think that second half comment took it down. But nevertheless, if you go back to the statement, look, strengthen its position in oil and gas, seeing sustained demand from existing and new clients for refits and refurbishments along with new projects. Great. After a challenging period in the gaming sector, the company is now seeing encouraging signs from the North American market. It recently secured 3 contracts: Ontario, Omaha, and Maryland, which is where, of course, the Buffett's from. With a combined value of $2 million to be delivered. 2 of these are new sites for existing customers. A third is for a new customer. This will see look at this. This will see their software implemented across multiple sites. And the software side of it is recurring revenue. I really like Synectics. I think, well, share price has done well, but don't worry about that. If it's got good value, still growth, it's fine.